In this short video, we're going to explore the asset model that is used within the calculator. The selected asset model must consider a wide range of asset classes. These are assets such as shares, properties, bonds, or cash. We need a sufficient number of simulations so we can understand the range of outcomes that could impact a retiree. This is required to better understand the risk of a tail event, such as a stock market crash. Very importantly, each asset class must have the correct correlation with inflation and as well as other asset classes. These correlations need to reflect what has happened historically. We also require that the asset model reflects current market conditions. At the time of making this video, interest rates were considerably lower than their long-term average. Importantly, we require that the simulated returns for each asset class tends to the correct long-term average and has a standard deviation that is consistent with historical experience. Whilst we're very proud of the asset model that we've built and that is used in conjunction with our calculator, the asset model simulations can be replaced with another set of simulations, perhaps from an asset consultant, or even with bootstrapped historical data. In the video, you can now see a screenshot of the software in operation. The chart shows the first simulation for inflation over the projection time horizon. There are 2,000 simulations used in the asset model, and what we're now doing is scrolling through just to see the impact of changing the simulations. Here, for example, in the 7th simulation, we can see that there are times when inflation is below zero, it's negative, and also times when inflation is much higher than the long-term average. But these events are actually quite rare. Here in the 8th simulation, we can see visually the correlation between inflation and returns from other asset classes as well as wage inflation. So we can see the impact of wage inflation in the simulation. We can see how cash returns are correlated to price inflation. Inflation-linked bonds are a lot more volatile, are also correlated to price inflation, and shares are extremely volatile. We can get a better sense of the correlation between asset classes by having a look at the scatter plot of returns under different time conditions. So if we consider, for example, wage inflation versus price inflation, we can see that the correlations are quite high. Similarly, if we look at, for example, cash returns relative to price inflation for a 1-year period, and this is the 8th simulation, we see the correlations are very high and rise even further when one considers longer rolling time periods. The same is true of other asset classes. Government bonds tend to have a low or negative correlation to inflation over a 1-year period, but over a 10-year period they tend to have a much higher correlation, and in a 20-year period extremely high correlations. Inflation-linked bonds have the same feature. Over a 1-year period the correlations are low because of the duration effect on real yields, but over longer time periods the correlations tend to be extremely high with inflation. Even equities, which have very low correlations over a 1-year period, tend to be highly correlated over longer time periods, as can be shown in this chart, and that's just for one simulation. We can also consider differing simulations, and you can see over here, over a 10-year period, Australian shares are moderately correlated to inflation, regardless of which simulation is used, and you do get slightly different results for each simulation. Another way to explore the simulations that have been produced is to consider the distribution of returns or inflation over time. This chart shows a distribution of price inflation over the projection horizon. The dark blue line is the median simulated result. The red areas show extremely low and unlikely inflation results, and the dark green areas again show extremely unlikely and extremely high inflation simulations. We can also explore how the distribution changes over time. For example, by considering the distribution of returns in the first year, in other words, 1 year from now, we can see that inflation is expected to be, according to this stochastic asset model, just below 2%, below its long-term average. In Australia, the long-term average is closer to 2.5% to 3%. We can also consider the distribution of inflation as we increase through time across the projection horizon. And we can see that the average inflation rate rises from 1.8% to its long-term average of 2.5% within a few years. We can also give consideration to the distribution of returns for cash, which also starts below its long-term average and rises over time to its long-term equilibrium level, which is above 4%. Similarly, for government bonds, these start off with a lot lower than long-term average returns, currently below 2%. That is below the current real to maturity for government bonds in Australia, because the stochastic model presumes that interest rates eventually rise, which puts a capital drag on returns. The chart also shows that the distribution of results for Australian shares has a much higher variance of volatility than for the asset classes that we've seen so far. International shares, international equities unhedged, are shown in the next chart. Again, variances, stand volatilities considerably above 10-15%. Emerging market equities are shown, and these have even higher volatilities but also higher expected returns overall. We also have unlisted assets that we make use of in the modelling. Direct property, these are commercial industrial properties, tend to be a lot less volatile than shares. And we also give consideration to residential homes in Australia. That's needed in the event that we want to consider leasing equity from a personal home if a retiree happens to own a house. Having considered the distribution of returns, we can now turn our attention to the construction of the efficient frontier, which is then used to find the optimal growth and defensive portfolios. In later videos, we'll be explaining how these optimal portfolios are used in the calculator. A little background is required. The efficient frontier represents the combination of asset classes that generate the highest return for a given level of risk, which is, according to modern portfolio theory, the volatility or standard deviation of returns. We must stress that in our view, risk represents the danger of not meeting one's investment objectives, not the volatility of returns. Nonetheless, efficient frontiers are commonplace in finance and are useful to determine the optimal growth and defensive portfolios. We start by selecting the start and end years and the tax rate that applies. 0% tax is used for members of superannuation funds who are retired, 15% for members of super funds who are actively working, and higher tax rates can also be selected. As can be seen, by allowing for tax, we reduce the expected return considerably, and volatility of returns reduce slightly as well. The red dots represent the return given on the vertical or y-axis and the risk given on the horizontal or x-axis for differing asset classes. As an example, this dot represents Australian cash returns, which are expected to generate a return of around 3.5% over the next 5 years, with a 2% standard deviation of returns. On the other end of the spectrum, we have emerging market equities, with the highest expected return but with extreme volatility. The blue triangles represent asset classes that are constrained because they are illiquid, such as infrastructure, direct property, hedge funds, and private equity investments. It's usually ill-advised for retirees to build a portfolio of only illiquid assets, as they would be difficult to sell in an emergency, so their holdings are limited in the efficient frontier that gets constructed. The green circle represents residential property, which is important if a retiree owns their own home or has any investment properties. As can be seen in the chart, the software shown employs a sophisticated optimization procedure to find the combination of asset classes that create the highest expected return. The derived return is the expected return net after tax, limiting the use of constrained asset classes, and disallowing a negative holding in any asset class. We can see the optimizer running in real time, actively trying to find the optimal combination of asset classes that generate the highest return for the given level of risk. The light green line shows the efficient frontier. It's impossible to find a combination of assets that lie to the north or west of that frontier. We're looking for the optimal combination of growth asset classes over the specified time horizon for the given tax rate, as well as the optimal combination of defensive assets. These are given in the yellow squares shown in the chart. We can now explore the resultant optimal growth and defensive asset classes. The optimal portfolio is the portfolio with the highest Sharpe ratio or the highest risk-adjusted returns. We see that the optimal growth portfolio has around 25% allocated to emerging market equities, 60% to high dividend yielding Australian equities, 10% to low volatility hedged international equities, and roughly 3% to small cap international shares. The optimization process gravitated towards high dividend yielding Australian equities because this calculation was done with a 0% tax rate, and the franking credits from Australian equities boost net of tax returns considerably. The optimal defensive portfolio has a 30% allocation to Australian floating rate notes, 50% to global floating rate notes, and roughly 20% to Australian credit. The reason for the high allocation to floating rate notes is that these instruments tend to have low duration and hence aren't overly impacted by rising interest rates. The table to the right shows the average returns and standard deviations for the optimal growth and defensive portfolios as well as for cash. Note that the optimal growth portfolio has a higher return and volatility of returns or standard deviation of returns than the optimal defensive portfolio.